Buddy. Pro Capital Wealth Management was Wealth Management 101 today. Appreciate you guys showing up, taking a look at this video, and coming to check out a little bit or educate yourself a little bit on what's going on. Today we're going to hit on some quick hit topics, but first I want to introduce myself, introduce my firm, and give you a little piece of who we are. I'm going to expand this picture here just a little bit. Get this. Whoop, here we go. Hopefully you guys can see this all right. So this might be getting this. Here we go. My name is Corey Proctor. I'm the owner and founder of Pro Capital Wealth Management. And usually I get asked the question, I wanted to share a little bit about our founding, how we operate, and how our story might relate to you a little bit. And so I often get asked the question, how and why did you get into what you do? And we all know that we're a product of our past experiences and in our lives. I'm no different. And I've had plenty of these that have led to what I do now. And I'll share a couple of those with you. Just for one instance, I was in a car accident when I was a teenager, rear-ended a lady, and pulled in. I still remember pulled into her apartment just fine, and we exchanged information, had the police come out and file a report, and everybody seemed okay. Well, not too long after that, she filed for, we got a letter from her attorney filing lawsuit, claiming damages and lost wages. And so to say that had an effect on our family, right, would be an understatement. I played in the NFL for 6 years. Mostly with the Dallas Cowboys, also with the Detroit Lions and the Miami Dolphins. And we all hear about pro athletes and how they spend their money, make bad investments, or go broke. Well, I even had one friend that I saw who lost $12 million in one investment, ended up being a really bad deal. And then in my family, we've lost people, we've experienced sickness, and we've seen how medical bills can really stack up in an instant. And how sometimes you're left with no other choice but to use resources that are available for that and to cover that bill. And so it's a big deal. And so these experiences really taught me a valuable lesson, and that's that money gives you choices. And so to protect my family and our future, I want to make sure we have those choices moving forward. And so that's what we're all about here at Pro Capital, is making sure we're protecting our clients' assets, portfolio, and their purpose really going forward as how they define that. And so that's what we're all about. And so I want to share a piece of that, the picture of my family, where to reach, how you can get a hold of me and at Pro Capital. Go onto our website, procapitalpx.com. I'll have other events. I do monthly webinars and other random events. We're having another one tonight here in Trophy Club, Texas. So I'll have some people there for that one. So excited for that. So if you have a ton of wealth of information on my website, you can go get resources on retirement, investing, insurance, coverage, whatever you need. There's a lot of stuff that goes on there. So take a look at it. But overall, this is what we're trying to do. And then if you need something by the end of this, have questions, you can file a question on the website or email or call directly to the office. And so that's a good way to do it. So we'll go ahead and get moving. So today, we're just doing this little Wealth Management 101. So going to cover some basics, just a little bit of market summary, strategies to help protect your lifestyle from rising costs, common investing pitfalls, and some key principles in investing. And so this is a little bit of a quick hitter today. I'm going to try to get you out of here in 30 minutes or maybe in around that time frame, but just want to give you some pieces to really equip you up in your portfolio, whether you're self-managing or you're working with an advisor, or maybe you're investigating working with an advisor and checking us out. Want to give you a few pieces to really chew on. So we'll go ahead and get started. Market summary. So this is a picture of the last 10 years, starting from 2018 and back. So 2018, 10 years of our market and what's gone on with the S&P 500. Well, It's a good deal. You can see just kind of zoomed way back here what this picture shows is in general the S&P has climbed up in that time frame, which is great. You would be right. Nobody would refute that. What this doesn't show is any sort of market volatility zoomed in or close up on this picture. And so if you're somebody who's following along and you've seen the ups and downs of your portfolio, you'll remember here at the end of 2018 on this picture, you remember in Q4 18 how it just took a dip, a big plummet in that last quarter, and all of a sudden we had a negative year, which looked like a really promising one, but all of a sudden we had a negative year and it wasn't, and it sucked to be to be honest. But why I bring that up is because life is not so zoomed out like this all the time. Over time, yes, it has gone up historically, but life isn't always this zoomed out, and so we can have, there's a lot of issues that might come up in these focused areas where there might be some market volatility that we need to pay attention to. And so these are areas that we got to watch, including even zooming in or coming into where we're at today in our market, where we have a lot of things being affected by the recent pandemic, by stimulus bills from the government, people going back to work after unemployment spiking up from the shutdown last year, lots of different reasons. So we have even a whole lot more interest in the market from different meme stocks that are going on, different cryptocurrencies that are taking place. There's a lot of more interest in the market for people just diving in for themselves, which is fantastic. Love seeing that, but can present some potential pitfalls. And so the state of the market, if you haven't been in it for a while, can be kind of a daunting place, or if you're in a winning mode, can seem like a euphoric place where you think you got it all figured out. Well, it's not always the case, but we want to make sure we've been in it consistently. We're taking an active look at our portfolio and what's going on with our markets and the economy that's going on. So this is just I wanted to show a quick look at this, but it's important because as we zoom out or zoom in, it both can have a big effect on our money and on our assets in our investment portfolio. So it's a good thing to be aware of. We kind of move along. Strategies to help protect your lifestyle from rising costs. So rising costs, when I refer to that, talking about inflation in a big way. There might be some other costs like taxes we'll talk about in a second, but inflation is a key thing. Always been kind of a worry in people's back pocket. Historically, inflation has sat over 3%. I thought it sat about 3%. Right now, it's about 1.5%. Although GDP, gross domestic product, has increased pretty significantly since the shutdown and since we're trying to open up our economy again. But all of that affects inflation. Right now, it's about 1.5%, but we could look at going above and beyond that. But what inflation affects is overall cost of goods and just general doing business. But take a look at this inflation checklist. All this is showing right now was the cost of average cost of a single family home, a loaf of bread, and college education costs per year. So in 1991, single family home was $97,000. You can see all the way up to 2019, it has jumped up to the average family home costing $376,000. Massive growth, a massive inflation of goods that we got to account for. A loaf of bread, this is more specifically just talking about white bread or Wonder Bread if you live a little bit in the past like me. But in 1991, loaf of bread cost 72 cents. All the way up to 2019 to $1.26. And if you like, any grain or whole nice, good bread that's a little more healthy for you, this can jump up to $3+ per loaf. And so there's some, but the example here is showing what inflation or the effect of inflation, what it has on the cost of goods. And then the college cost of education per year, you can see in 91, this thing was at $5,400 plus a year and has skyrocketed in 2019 to over $26,000 per year. And on average, that's got an inflation rate of about 5%. So college cost has really come up lately as an issue or a hot topic even as the government had taken over student loans not too long ago. So, you know, these are some issues. So anyways, the whole reason this slide is up here is inflation is a problem. I'm sure many of you are aware of it, but inflation is the number one reason why people invest, and that's because we have to make sure our money is staying in line with inflation. It doesn't guarantee it, but we have to. That's one of the major goals. And then obviously, as we take income or want assets in retirement, we got to be able to take money out of those portfolios and still have money to last if we're looking at something like that. So this is a big deal. This next slide is going to look at exactly that, the retirement portion of that. So what we're looking at here is basically your current income or your expenses, the amount that you're spending in your house. And let's just say someone is spending $50,000 a year or having in expenses in total. And this is at 2 and 3 and 4% income. Well, if we stay at our current inflation rate, you know, that 50,000 in 35 years turns into 100,000 needs. So I got it in 35 years, I'm gonna need 100,000 to live off of if I stay the same that I am today. And the same 3%, you see 50 turns into 141. And then if it really skyrockets inflation, that 50,000 turns into almost 200,000. That quadruples almost in that 35-year time frame. And so this is just to emphasize the need for putting our money to work, depending on the goal. But this is a real issue that we look at when we need to implement some sort of strategy for our portfolio. And so it becomes a real big look or a real big deal. And so, okay, now we start looking at actual strategies or other things that we have to look at. And so taxes becomes one to look at when we're trying to protect against or maximize our investment portfolio somehow. And so we'll look at ways to manage our income taxes and ways that we can do that. Some obvious ones are maximize our contributions to any retirement accounts. If you're working and you have an employer-sponsored plan like a 401k or maybe a government entity, you have a 403b, we want to maximize. Right now, we can put $19,500 a year in right now, plus any employer match. And if you get that employer match, I would absolutely take advantage of that, depending on your situation. But we can also try to manage taxes down the road. We can try to jump into a tax deferred vehicle. I think I'm getting ahead of myself a little bit. Yeah. But we can try to maximize these accounts anyways. We come into this, before I jump ahead into that deferred portion, you know, we'll jump into those deferred vehicles with our maximum contributions so we can cut down our tax liability on the year. That's a big deal. And also to take advantage of that deferability till retirement. As we max that out, if we have enough funds to go into some invested in traditional investing accounts that are taxable, then we got to start worrying about capital gains and other sort of qualified dividends as ways to eat at our money or eat at our gains potentially. And so long-term cap gains, anything that's held over 12 months right now or a year gets a favored rate. Potentially looking at might change in some of the new tax brackets or new proposed tax proposals that come out from the Biden administration. Right now, we've been in one of the best federal income tax brackets we've ever seen from the Tax Cuts and Jobs Act from the Trump administration. So everybody has benefited from that to a degree. And so, but there are some proposed rates that are coming out, and those might increase. And even long-term cap gains, one proposal of anyone with over $1 million in income. So we'll see what happens with that. But for now, we got to just take a look at anything that's currently in place and in effect, and so we project off of that one. So, but if we start looking at investment selections or somebody's portfolio allocation, you know, you got to take in consideration these kind of effects that are going to be essentially eating at their portfolio. And so what you could do, say you're in a taxable account, you maxed out your retirement accounts at work, we could try to go into another tax deferred allocation of some way. And so that could be starting up a brokerage account if you don't have one already. It could be a traditional IRA, a Roth IRA for potential tax-free income in retirement. That's always a good route. You can go into, there's annuities out there that just with non-qualified funds that you could designate for retirement that can get you some tax deferability. There's even some life insurance products out there that you can go to that you can permanent life policies you can go in to get some tax deferability and even potentially get some tax-free retirement replacement out of those loans, out of the death benefits that some of you guys may have heard of. There's some of those portions, but as we're trying to make sure we account against taxes, or we try to minimize our hit throughout the years, going into a tax deferred bucket might be a way to be able to combat that a little bit. One of the other things that we got to look at when we're looking at managing our portfolios is longevity. Right now, Americans especially, we're living longer, which is a great thing, but it comes with its own risks also, things that we have to account for. We live longer, that means we're going to spend more, we're going to eat more, we're going to consume more, we're going to have more consumption, not just in food, but in entertainment and lifestyle and everything that's going on, fuel for driving, if we're still driving at an elder age, but our consumption is still there. So we have to account for the cost and account for our assets outlasting us and not us outlasting our assets in a big way. So on this, you can see life expectancy from age 65, males. This is for anybody who questions why life insurance is more expensive for men. That's because in general, they live more aggressive lives, typically more dangerous lives, and they don't live as long as females. So females are a lot of times cheaper, depending on the situation. But the percentage of chance of a 65-year-old moving on, you say to live to 85, 41% for males, 53% for females. And if somebody's married or living together, 72% chance of longevity for 65. So man, I kind of look at that and I think I'm glad I got my wife, because I got a higher probability of living a longer life. So I'll take that. And then you see this is to live to age 90, 20%, 32%, and 45%. And so that's just, you can see the probability here. And why that's an issue is as we start looking at our portfolios, naturally our consumption is still there. We have to make sure our assets last longer. Well, when I'm talking with a client and I say, okay, we start setting goals of income in retirement, and we start looking at withdrawal rates and what we're going to take out to make sure that that income is covered, or those expenses are covered, or that lifestyle is covered. Our withdrawal rate can really affect the longevity of our accounts, not just the longevity of our lives, but the longevity of our accounts. And so on this graph, you can see this purple line beside the code bar here, 4, 5, 6, up to 9% withdrawal rate. So that means, let's just say I have a $1 million portfolio and I'm taking a 4% withdrawal rate. That would be 40 grand a year that I'm taking out of that account. And so this is just going off a portfolio that's set at 50% stock, 40% bonds, and 10% T-bills, which is pretty typical. But you'll see traditionally in the industry, there's always been a 4% draw rate. And why that is you can see the projection here on a traditional portfolio. Well, that might give us enough to keep our potentially to keep our portfolio growing. If we're able to grow above that 4% and really put us in a hopefully a better scenario to not outlast our money in a sense. And so we always have resources to live our lives. And so in this case, it shows the 4% really lasting. Well, what I want you guys to see is, okay, what if we dialed it up? What if we didn't have enough in the bank to really cover for the need long-term, or maybe I need to take a larger withdrawal rate out for whatever reason. So I dial that up by 5%, by 1 more percent at 5%. You'll see this blue line, just by dialing it up 1% more, it changes the trajectory of that money outlasting. Now, this lasts in a great way. So if we're only living to mid 80s to 90, you know, we're retiring or we're passing off with a legacy still and able to outlast or have our money outlast us, which is great in this illustration. But if we had to dial it up even more, and say somebody hasn't gauged where they're at, or you might have heard stories where somebody was just kind of fed up at work and like, that's it, I'm done, I'm retiring. And they didn't actually project out what they needed for retirement to sustain that. Sometimes you'll end up with people that have to take out a greater withdrawal rate from their accounts, which can significantly affect the longevity of that account. And so you'll see that just by 1%, that 5% flattens out quite a bit instead of having an increase. 6% drops off and ends, money runs out mid 80s, and then dial it up a little more, 8%, 9%, it actually starts falling, and you really start getting into that age range, you know, where our average is mid 80s, longevity average, or the average life expectancy in America is mid 80s. You see people, you know, if I'm drawing at a 7, 8, or 9% rate on my accounts, that comes at 80 or before, and now we're facing the problem of running out of money before we pass, and that's an issue. So this has become some things that we got to look at when we're managing our wealth, either for ourselves or for other things, or we have an advisor. These are questions to bring up for sure. Another big issue is healthcare costs. As we live longer, the need for having some sort of assisted living in home, or maybe in a nursing home, or in another realm, or just some sort of home health aid, those costs can really skyrocket. And today, conservatively, this has come up a little bit. You see this $39.94 per month. It's come up a little bit to conservatively. We'll be around $4,000 plus a month at the low end if we need some sort of home health care. So when you're talking to your parents, maybe you're in the situation, you're talking to your parents, you know, really we start looking at, okay, what's your ability to take care of your spouse if they fall into a home health care need where they can't take care of something, they can't go to the restroom themselves, they need help physically to get around everywhere, maybe to eat. Maybe we go into some sort of Alzheimer's issue, where whatever the case might be, they need help living every day. And maybe the spouse just doesn't have the capability to do that, or maybe they have their own issues they got to look for. They got to have help. This is where home health care costs, or healthcare costs in general, could be a real big deal. And so something you might look at there is like some sort of long-term care insurance, which can be a real big deal, where I have recommended people buying long-term care coverage for their parents, because frankly, I've seen areas where people, they didn't account for this, but this could torpedo or train wreck a portfolio really fast. When you think about bottom end, if I'm having to spend 48 to 50,000 extra a year on some sort of home health care, that I didn't account for in my investments, well, that could drive it down in a big way. So something to think about or plan for when we're managing our portfolio in a big way. Let's move on to just a couple pitfalls that we look at when we're investing. We're going to look at just a couple here, and then we'll get into these key principles to look at. Just a couple slides on this one. The biggest pitfalls people fall into is the emotional roller coaster. There's a lot of people that just kind of let their emotions dominate them, and if you do that with your money, that is not a good thing. And so what happens traditionally, especially right now, where people are excited about these meme stocks or crypto or any other thing that's kind of been big in the news, they want to jump in themselves and try their hand at it. Well, this can be great at first, especially if you catch an uprise or a big rise in value on a single stock or a speculative place or whatever. It doesn't matter what you're looking at. It can feel great, and you'll see I'm confident. You're like, man, I'm making some money, and you even get up on top of this high where it's almost euphoric. Like, man, I'm amazing at this. I should just quit my day job and go do this and become a day trader. Well, there is people that do that. Well, the problem with that is it's upwards of 80+% of day traders lose money And so we become very emotional in this choice. And all of a sudden, when that starts coming down and we're not sure exactly, we think we know what we're doing and we're not sure we know what we're doing, things starts coming down. We start getting nervous. Shoot, we start getting desperate as it dips down even more. And then all of a sudden, we see the market or a security come way down, and we just feel defeated because we've lost all this money or we've lost a ton of value. And it's a tough thing. And then we see this upswing where it can begin to be hopeful again. But the tough thing is people get into this emotional place and they're like, man, I think I'm really good. And then there's this big value loss and they're just feeling like they're totally defeated and not where they need to be. And really those are when opportunities have presented themselves in big ways, right? If there's a big discount, I want potentially the average bounce back off the S&P 500 through 2019 was off a 1-year bear market return on the S&P 500 was 41%. So if I can get a piece of that average, historically speaking, that would be fantastic. And so it's a great place to be. But if you're caught in this defeated place, you usually want nothing to do with it. And so if we're not careful and we don't manage our behaviors or our emotions through this, that affects our behaviors in a big way and could potentially torpedo a portfolio. And so these are pitfalls that we got to look out for in a big way. So just to kind of emphasize that, the way we got to tune out emotion, I want to show you the average investor right here. Their average return is 2.3 above this 2.1 inflation right now. It's showing on this graph, and this is only through 95 to 2016. But what it shows is that if so many people if you just act on this emotional roller coaster, you're not setting yourself up for success potentially. Historically speaking, you're setting yourself up for just kind of flatline or losing. And I'm not in the business that I don't want to be that. I can't guarantee any returns on anything, but I want to go where things are proven and we project for the long term and we allocate our portfolio in that respect. And that way we got a plan, because if we can stick to the plan, we can work towards that in a big way. Moving on, key principles of investing and a little bit more, and then I'll get you guys out of here. So one of the biggest pieces we got to look at before anybody else, a lot of money managers, they'll look at your money and they'll begin and they'll end there and they'll never go anywhere else. But what I want to look at typically when I'm managing a portfolio is we got to look at risk first. And so I kind of like these things that go under here. We can ignore, avoid, manage, or transfer. And really it becomes down to transfer or assume risk. And so these first three is under the category of assuming that risk. And so I could ignore the risk and so say, if I crash my car, I'll just buy a new one. But I got to say, if you're at 20 years old, I might have been able to say that, where if I lost it all, I could rebuild it. But at 40 years old, I don't really care to say that. And I know at 60 years old, I really won't want to say that. So, this is a little bit kind of a reckless way to do it, but some people do it. So you could ignore it, crash. If I crash, I'll buy the new car. We could avoid risk, and I just won't drive at all, meaning I just won't invest at all. People don't understand that even just money sitting in the bank in cash has its own risks associated too. So if we still have inflation and money is sitting in the bank, inflation is eating at that cash, and we're losing value on that dollar or purchasing power on that dollar right away anyways. So there's still risk there, even if you try to avoid it. We could best one of the ways to do it is manage the risk. That's what we got to do in a big way. If we're going to assume it, we got to manage this risk. If we're driving a car, we're going to keep our hands at 10 and 2. We're going to stay alert at all times, and we're going to be paying attention to the road, and in the same way, paying attention to our accounts. And then if we want to transfer that, we could just buy car insurance and make sure if we ever got caught in a wreck, insurance would take care of the damages for us, and we'd still be covered and be able to live our life. And so you can do that too. Different ways to do that, but we can look at that's what we got to look at. The major principle when we're talking about investing our money. We've got to realize what risks are we walking into, what are we exposed to, what are we willing to take on ourselves, and what do we want to transfer. So big deal there. And then as we move forward, you got to look at your tolerance level. And so if you're, a lot of times I'll talk to couples and the guy might be the super aggressive one where he'll be like, man, go for the moon, and you make as much money as you can. And I say, okay. And I'll have a husband and wife there a lot of times. And okay, so let's just say you got $1 million in the account. And this last February, March, during the pandemic, we had a 30% drop in the market. And let's say that $1 million went to 700,000. Would you be able to stomach that? Would you be able to take care of that? And a lot of times the wife looks at it and she goes, ooh, I don't know about that. And she goes, let's pump the brakes there, big boy, and wants to reel it back a little bit. And so it's a good thing that happens, a good conversation that happens, because there we start really determining what's your tolerance level for this risk and for the fluctuation in the market. So, that's going to determine whether you have a low, medium, or high tolerance. That's going to determine what kind of allocation you have in your portfolio. And if you have a low tolerance for volatility in your market performance or in your dollar values in your accounts going up and down, you're not going to be able to handle the anxiety that goes with a high risk portfolio or a full equity portfolio potentially. And so those are things that we got to take into account. And then from there, you select a suitable investment. And I like this slide a lot because there's been studies that have been done that have shown that asset allocation is the primary factor that influences volatility and return in a portfolio. And so there's two here. In a 1991 study, it showed that asset allocation was responsible for more than 90% of a portfolio's movement over time. And then in 2012, they did a repeated study that showed that 88% of a portfolio performance over time would be attributed to the mixture of assets in the portfolio. The other 12% of that would be security selection and market timing. So just purely trying to time the market. Well, I tell you, I wouldn't be in the business. I wouldn't need anybody. I wouldn't need to be in the business if I had a crystal ball, could see the future, and I could time everything perfectly. So I would be wary of anybody who tries to say that they know something's coming or they're trying to time the market perfectly. That is an imperfect way to do things. And so I would be wary of somebody who starts talking like that in a big way. Bottom line, though, it's not picking winners or jumping in and out of the markets that really determine your long-term investment outcome. It's picking the right mix for your situation, and it's about your life. And so about your purpose and where you're going in that. And that's a big deal. The biggest takeaway I would give you from all of this is stay active in your portfolios. Stay active in your money, stay active in the securities of your home, your cash flow, stay active in your own balance sheet. And as long as you're active in there, you have an idea of the behaviors of your money, you have an idea of what's going on. And when you have that basic understanding and you know what's going on in the behaviors of your own accounts in your household, you are starting off on a lot bigger foot than the rest of the norm. And so that you'll have at least a tuned in key or in your life to make an informed decision. So, or when you're coming to talk to a professional to do that. And so to kind of close it out, if you got questions or maybe something like this, raise it up, anything that we talked about, shoot me a message, reach out, look at the website, procapitaltx.com, do more research on your own. I'm always an advocate for that. But check me out. I want to make sure that I am protecting people in a big way, similar to my story I shared you at the end. Maybe you're a person, if you ever found yourself in a situation, against market volatility or market meltdown and judgment or lawsuit, I work to make sure I protect my clients at Pro Capital here against those types of extremes. And I want to make sure that they're protected, their purpose is protected, their assets are protected for their life and their goals, how they define that, and to make sure that they're good going forward. Thank you guys so much for coming today. If you have anything else you need, please jump on the website or give me a shout, available anytime, and we'll get that done. Appreciate it, guys. Bye.